Good morning. The double hit. Why shutdowns hurt both CRE values as well as lending and liquidity. So, when Washington goes dark, so does confidence in the market. Government shutdowns don't just pause operations, but they ripple through the economy, which creates uncertainty that hits commercial real estate or CRE from both sides. Values decline and financing dries up. I hope that we get the resolution soon. The confidence shock. How uncertainty devalues CRE. At its core, CRE thrives on stability and predictability. When the government shuts down, critical data releases, from employment reports to inflation numbers, are also all delayed. Investors, appraisers, and lenders lose a little bit of visibility into the market, and that disrupts things. Without clear data, investors pull back. Cap rates could expand, valuations could compress, and transaction volumes could drop. Now, owners holding stabilized assets could see fewer offers and lower price points, while developers and buyers adopt a wait and see posture. We need to get past this. Shutdowns don't just affect federal employees, they shake tenant confidence too. Businesses that are dependent on federal contracts or consumer spending will start cutting back, reducing demand for office, retail, and even industrial space. Now, the flip side of the coin is there's a liquidity crunch. Lending pulls back fast as well. When confidence fails, liquidity is the first casualty. Banks and lenders tighten underwriting standards, delay closings, or pause new applications altogether. For instance, we've already seen a credit score limit increase for DSCR loans, which is a little bit unusual. Government-backed lending programs like SBA 504, particularly 7A, USDA, and HUD multifamily loans will grind to a halt because federal employees aren't there to process approvals or guarantee funding. Even private and non-bank lenders grow cautious as they can't price risk accurately without the federal data from agencies like the Bureau of Labor Statistics or the Treasury Department. And that uncertainty widens spreads and slows deal flow, which means that investors and business owners could face both higher costs and longer timelines for financing. And nobody wants that. Ain't nobody got time for that. The feedback loop is value and liquidity feed each other. And here's the kicker. Declining CRE values make lenders even more conservative, which further suppresses liquidity. So it's which came first, the chicken or the egg? When liquidity drops, fewer buyers can finance deals, which pushes values lower because there's less competition on the front end. And this feedback loop just reduces confidence, lowers values, tighter lending, fewer transactions. Literally, it could freeze entire markets until political stability returns. So, what should savvy investors do? Well, focus on what you can, strengthen your cash positions. Liquidity is power during uncertainty. Lock in favorable financing early, and don't wait for volatility to spike. Should focus on essential assets, so industrial, medical, and necessity retail tend to hold value best in these little periods. But remember, we got to stay data driven, follow state and private market indicators while federal reports pause. Shutdowns eventually end, but their impact on sentiment, appraisals, and lending spreads can linger for months. So let's get through this. Smart investors plan for the next one now. And that's it for the day. You have a good one.